And what better day than today when, we've already had a tumultuous and volatile oil market, and what we saw in the last 24 hours beats all of that.
It sure does, and really what we're seeing is what I like to call a whole new world order of global energy oil producers, and we're seeing that. I mean, OPEC is really no longer effectively operating as, the cartel and directing price. So, I mean, yesterday's decision to, hold the line, keep production at 30 million barrels is, I can't say that it was unexpected, but really what it does is open up the field for a whole new level of competition. And I will, like everyone else, will see prices. I could see prices going down into the south of $50 per barrel.
Wow, $50 a barrel. It'd be hard to imagine just a year ago.
Yes, that here we are sitting and talking about crude oil prices, south of 50, I think is plausible. Keep in mind, the last time that OPEC did make a production cut, we have to think back to 2008 when we're in the midst of the, economic crisis, and prices dropped to $45 per barrel. So, I mean, there is precedent for them cutting. I think what you'll hear, though, is that smaller countries within the OPEC cartel begin to get louder and louder and louder as their economies really feel the pinch.
Now, you mentioned about a new level of competition. Are you talking about OPEC against U.S. shale oil producers?
Yes, indeed. So we have U.S. shale producers, you have Canadian oil sand producers. I mean, this is now, the OPEC face-off against North American global oil producers. And it's going to be about cost structures and who has the lowest marginal cost. And, it will vary. Larger producers will remain in the field. Smaller producers will go by the wayside. But I don't think it's going to stop. I don't think shale production is going to stop based on OPEC's
even though it's much more expensive to do this, though?
I think for the larger producers, they have a different cost structure than the smaller producers.
Okay.
I mean, this is very analogous to what we're seeing in the natural gas market today.
Well, Gianna, on that point, we spoke with John Hofmeister, who's the former president of Shell, and he spoke quite a bit about some of these oil producers and how some are unprofitable now at this $68, $70 level we are at. I want you to listen to what he said about that.
Sure.
We're going to see some reductions in drilling rigs in the U.S., no question, if the prices remain where they are today. That's going to immediately affect the decline rate in the oil fields and in the shale formations, where you have decline rates at 50% per year. You're going to see a lot of oil come off the market.
Would you agree with that?
We'll see that by the smaller producers. The smaller producers have very high cost structures, and I believe that they will go by the wayside. Larger producers, the Marathons, Exxon Mobils of the world, I can't see them slowing just yet.
OPEC, though they decided not to cut production, hasn't made it any more clear, though, what they're going to do next, right? So, again, it's another kind of waiting game here. So for the major oil producers, even though they might be okay, Gianna, here with shale oil production, aren't they still sort of in a game of chicken here with OPEC and trying to figure out what they're going to do and try to react beforehand and game that out? And that's going to happen, keep going for the time being.
Yes, it is. I mean, they're going. It's a question of who can, go lower. How low can you go, and who can keep producing at the lowest possible cost. So yes, we all have to wait and see what happens. But I mean, there is precedent for OPEC, cutting production levels. When they hit $45 per barrel in 2008. Okay. We'll see if prices go lower, and we'll just have to wait and see what happens.